Let me first welcome everybody who is over here and with us today, this evening. And we are so glad that we are here together. And as you all know, Calcutta Management Association is the oldest management body in the country. And over the years, we have had the honor of hosting some of the most eminent luminaries of the corporate and academic world. And their knowledge, wisdom, and thoughts have enriched us immensely and helped us fine-tune our professional lives. We have organized a series of webinars called Leadership in Turbulent Times, which is designed by CMA to evoke thoughts among us in these challenging times with the advice and guidance of leaders from the management fraternity. Today, we are focusing on COVID and its influence on the state of the economy, with special reference to the banking sector. A few starting points. The COVID-19 lockdown has forced the Indian society to live between anarchy and totalitarianism. Lockdown disruption has been far-reaching. People face pay cuts, people face unemployment, some even face starvation. At this point, while this may sound very extreme, finding financial resources for fighting COVID-19 will be tough if the economy remains in a lockdown state. Labor has moved out and need to come back. Train services need to be resumed, obviously in a limited manner, so that taking people back and forth can help resume production in the country. McKinsey did a quick study in India, and on 6th May, they put out certain thoughts. They said during lockdown, India's economy has functioned at 40 to 50%. It is increasingly clear that COVID-19 will not disappear immediately. The economy will need to be managed alongside persistent infection risks, possibly for a long time. However, Indian businessmen, consumers, and workers will be ready to resume their activities, and they will have to decide how their lives and livelihoods will fare in India. Looking ahead, they suggested three considerations. One, India's intertwined supply chains need a sharply targeted approach. Economic activity allowed in one part of the country or economy could be constrained by supply and demand bottlenecks in other parts. How do we, in future, manage that? Economic activity is concentrated in the red zone districts that are critical centers of production and consumption. 130 districts classified as red zones are the most urbanized and industrialized parts of the country. With 41% of economic activity, 38% industrial output, and 40% non-farm employment, how do we keep these red zone districts operational as well as safe? On-ground implementation challenges need to be addressed. Almost all activities have been permitted, including those in red zone districts, while specific containment zones within districts need to stay locked down. State governments are considering, alongside healthcare capacity levels, virus screening, scanning, tracing, containment, their ability to enforce safe work protocols. With these factors coming into play, many red zones could continue to remain fully locked down in the near future. How do we manage that? So the solution may lie in granular, dynamic, and locally driven lockdown and restart management systems, which need to fall into place. So how, parallelly with strengthening local health preparedness, do we lock down containment zones only, not entire districts, increase implementation capacity at district level, operationalize safe passage along key labor corridors, strengthen coordination and communication between the government and industry, ease industrial funding and managing industrial moratoriums, and look ahead and plan for contingencies. India's economy will need to function alongside COVID-19 for a prolonged period of time. There is much at stake for India in both lives and livelihoods in planning and getting this right. Ladies and gentlemen, We have the honor and pleasure of hosting Mr. R. Gopalakrishnan, Mr. Harshavardhan Neotia, Mr. T.V. Mohandas Pai, Mr. Sagar Darihani in the earlier episodes. And this evening, we look forward to yet another engrossing and thought-provoking session with none other than Dr. Soumya Kanti Ghosh, Chief Economic Advisor, State Bank of India. Thank you, Dr. Ghosh, for being with us. And thank you all for joining this program. A little about Dr. Ghosh, who has worked at Tata, AIA, American Express, and ICRA, among others. He has co-authored a pioneering initiative to capture payroll data in India for the first time. Following his report, Employees Provident Fund Organization and Employees State Insurance Corporations started to give out payroll data. He is currently a member of the working group that has been set up by the Government of India for the revision of Wholesale Price Index. He serves as a member of the Indian Banks Association's Monetary Policy Group and provided inputs to Reserve Bank of India's expert committee to revise and strengthen the monetary policy framework. He is also a member of the SEBI Advisory Committee on Research, Economic Advisory Council, CII, and Editorial Advisory Board of the Indian Institute of Banking and Finance. Dr. Ghosh is also a member of ALM Committee, Product Committee, and Risk Management Committee of the board at SBI. In 2018 and 19, Dr. Ghosh has been ranked as one of the best individuals in research in India by the Asset magazine. He has authored several publications on the Indian economy and co-authored chapters in 2 books in ASEAN, India Development and Cooperation Report 2015 published by Routledge, and a chapter entitled Revisiting Global Governance in Global Economic Cooperation 2015 published by Springer. Dr. Ghosh received his PhD in economics from Jawaharlal Nehru University. Ladies and gentlemen, let us give you Dr. Soumya Ghosh. Dr. Ghosh, please.
Okay. Thank you for a nice introduction. And I hope I'm audible. And over the next 30 or 40 minutes or so, I would like to take you through the virtual happening of what's happening in the global economy and Indian economy. And taking a detour through the virtual is always a pleasure. And that too also, even if I'm on a virtual mode, interacting with Kolkata is always a pleasure. So that actually is a, and this I mean, every day, as you know, the economic scenario is changing. Yesterday, the day before yesterday, the government announced a large borrowing program, and all of us are anticipating that possibly the government could come up with another fiscal support. So what I will do today is that I will give you a short state of the global economy. I'll talk a little bit about the Indian economy, how it's happening, and also about the banking sector and what needs to be done to get out of the current situation. So before I start, I think the first thing which we need to know is what is the current status, because unless we know the current status, the enormity of the problem cannot be understood. Now, the first thing is that if I just look into this current status, you will see that this is the history of the pandemic crisis across the world. Why I wanted to emphasize this crisis, this gives you a history for the last 500 years. You will see in the third column is that all pandemic crises have actually come back in waves. Sometimes it is 2, sometimes it is multiple. The most recent is the 1918 crisis of Spanish flu, which basically came back thrice. It is written about twice, but it is actually came back thrice. And the important thing is that whenever it comes back, it is even more deadly than what it was earlier. So, for example, in the Spanish flu, when it came out third time, the total number of people who were infected, total number of people who died was actually 8% of the overall number of the people who perished in that unfortunate Spanish flu. So we need to understand this before we start having a discussion of this pandemic, because until and unless a virus is found, which is possibly people are saying maybe 2 years away, we have to live with this pandemic. So any decision which has to be taken on the economic front or even on the political front has to take that factor into consideration. Now, this is the continent-wise COVID status now. As you can see, I mean, Europe is actually 39%, North America 36%, and Asia is actually climbing up the ladder right now, which includes India, which is now at 16%. And this is going to be, this is a matter of concern. It is actually across all continents. The only continents which is still left out is in Africa, but Africa, I believe, could actually pick up. I mean, and this has been the trend that it picks up in other countries and then goes to other continents. Possibly Africa could pick up after it has actually hit up after some point of time. Now, there are some myths which has to be, I wanted to break some myths today. Actually, we have been hearing that India has not been testing enough. But if you actually look into this slide, this is a very interesting slide which shows that where does India stand as of today, as of yesterday. India had 62,000 cases. So possibly India could soon overtake China. I am talking about the China recorded number of cases. I'm not talking about what has not been published. But if I look into the China, India possibly will overtake China in some point of time. But the important thing is that if you look into the number of tests, India has still done 15 lakh tests and it is counting. It is even higher than developed economies like Canada, like Turkey, like France, very close to UK, and it is not significantly behind, Italy. And I am sure that it will actually touch those levels in some period of time. So it's a complete misnomer to say we are not testing enough. So that's the first thing. But I'll not call it a downside. But the downside of that, and if you look at the confirmed number of cases, that is 4.1, and days per cases is 300 cases is 3.3. So the point which I'm trying to mention is that yes, India has now testing enough. So these confirmed cases per 100 tests shows that perhaps the disease has been contained. That's why the number is still at low levels. But on the downside, this is the graph which I wanted to show you. If you actually look at some of the successful countries like New Zealand, Australia, South Korea, which contained the crisis very quickly, India is still on a rising curve. And if you look into India's distribution, you can actually see that India is rising. And this is basically, there are two parts of this distribution, and you can always say of a curve. India's curve was relatively flat. Now it is rising steeply. And if you look into the other countries' graph like the South Korea, or even for that matter Austria, they rose very steeply and then it tapered off. But India, it has been rising steadily. So the peak, I think, will take some more time to come. I don't want to forecast on these levels because these are mathematical models and it's very difficult to predict. But my sense is that it will take some more amount of time to peak and then it will decline. So this is the important point, that possibly we may have avoided a community transmission. But the second point is that we have not yet reached a peak. So that's why we have to be very careful in terms of the transmission of the disease. Now, this is another thing which I wanted to show you, is that if you look at the doubling time of India, other countries, India doubling time, for example, of 64,000 cases is actually at 102nd day, because now we are doubling every 10 to 12 days. But if you look into all other countries, Iran, China, for example, did it in 28 days. India has done far better. So this is another good thing which India has done. So administratively, India has done very well in terms of comparing the disease. And if you look at the age-wise distribution, as you know, India is a country of demographically dividends. So that's why you can see that the population who have been infected, around 45% of the population are actually in the 21 to 40 age group, and 41 to 50, if I take, that is 16%. So basically 60% of the population are in the age group of 21 to 50. In fact, 70% of the population in the age group of 21 to 60. So that's an advantage, and the fatality rate of India has been remarkably lower. For the record, we always talk about India having a healthcare system which is not that good, but we also need to remember that in 2018, we had 4 crore pneumonia, total number of pneumonia in 4 crore were people having respiratory diseases, but out of this only 3,540 died. So that actually brings up to the question of whether the lockdown in the current form is justified or not. We'll come back to that later, but this is basically the point which I wanted to know. India is testing enough. That's a good thing. That means that India commodity transmission has not happened, but the bad thing is that India is yet to reach its peak, and this can take any time. This can take at least in my sense could be as much as month before we reach the peak. Now, let me come now to the next slide. Now I will talk a little bit about the economy, because that is important. Because having said that India has been successful in containing the disease, what it has done on the economy. Now, let me talk about the economy. I think we need to understand how the global economic outlook looks right now. I think we are in a crisis. This crisis is severe, and it is much more than any other crisis which has befit the world. It's a crisis where the issue is that, I mean, the crisis is significant because you need to remember that in this crisis, we are actually foregoing social consumption. What is social consumption? Basically, for example, eating out, going to movies, other things. And this social consumption actually cannot be made up at later point of time. You cannot have two lunches maybe in 3 to 4 months back. And India, and this is largely a service sector. India's share in service sector is 60%. In 2019, when the crisis happened, it did not impact the economy immediately. We were able to pick up because we had a very good stimulus package. We can debate whether the stimulus package was desired or it stayed for a long time, but the good thing is that the decision was made very quickly, and we had a very quick stimulus package. So, but this time the problem is that the service sector is going to be impacted significantly, and given 60% of our share is service sector, so for example, in the last quarter, our growth rate was 4.5%. So, and given the fact the service sector goes by 7%, if I take a 60% share, that means 420 basis points can be easily shaved off from 4.50%. So basically, without the service sector going, the growth rate this year actually could be zero. I'll come to that calculation later on. But the point is that global economic outlook is going to be significantly clouded. Commodity prices has dropped. FDI is supposed to drop. Financial markets have been volatile. And their important point is that there is a risk of relapse. There is no medical evidence to suggest that if you are immune to the disease, even if you have contacted it, it is not like measles. So there are examples like in Korea and China, it's already started happening. So therefore, the overall risk of resurgence in risk is still uncertain. But I would say that that's a very real possibility, because until a vaccine is required. So that's why the important point is that since the crisis is going to impact the service sector, we need to support this sector long after the pandemic has ended through a fiscal package, which I will discuss a little bit later. But the point which I want to make is that until and unless you do that, the financial sector will always be wary of the lending to the service sector. Now, coming to this is the GDP forecast for select regions. I can see that everywhere it's a colossal negative, and this is the forecast which has been made by IMF. I will come to the Indian forecast right now. And this is the oil price outlook. The oil prices actually this year has been declined significantly. As you can see that Indian basket was $20 per barrel in April 2020. I am saying that the crude prices will stay low in $15 to $35 per barrel. But my sense is that it could go below $10 per barrel in the next 2 to 3 months. That's a very real possibility. The future market has already seen a negative growth, and I will not be surprised. Now, for India, how big is the problem? It's a big problem because social consumption foregone today cannot be made up, unlike global financial crisis. So Indian business needs urgent support. There will be a permanent demand destruction in export markets. There will be a rearrangement in global chains. Remittances will decline significantly, and this will impact some of the states like Kerala, Maharashtra, Karnataka significantly. There will be a fall in inward FDI. The existing financial sector vulnerability could actually problem, and we have to be clear to protect them. And our problem is that lockdown in its current form is not going to help. That history of all pandemics show that until you find a vaccine, the problem will keep on coming back. Now, these are two approaches of understanding what could be the GDP approach. One is a top-down approach. Basically, top-down means you work from the center downward. If you work from the center downward, after a lot of simulations, our sense is that the real GDP growth rate in FY21 will be actually negative. It could be at minus 1.45%. And this is basically from an input output table which you have simulated. You can see the amount of output loss, which is at 16.5 lakh crores, and 2 lakh crores is equal to 1% of GDP. So basically 8 lakh crores could be 8% of GDP will be the total output loss if the lockdown were to continue as in the 17th May. And the total loss in labor income is around 7 lakh crores, of which 25% is because of the migrant labor, and capital income loss could be 4 lakh crores. A large part of it would be shifted to the banks because of this corporate crisis. So this is the extent of the problem from a top-down approach. And this is basically the several sectors. You can see key total out of 16.5 lakh, which are the sectors which is going to be hit. Transport and storage, for example, 42%, hotels, the 14%, trade 12%, agriculture surprisingly will lose 5% of the overall, and coke, petroleum 5%. Everywhere there is a loss. I don't see any sector where it will be no loss apart from the public administration and defense. So this is basically, so this gives you the nature of the problem, which is extent, which is significant and actually very devastating. This is the loss in labor income. You can actually see that labor income loss of 7 lakh crores is coming mostly in the transport sector, hotel sector, trade sector, even agricultural sector. Everywhere again there is an income loss. So this is basically the labor and capital income loss, and the capital income loss basically is largest in some of the industrial sector. You can see down, mining is one, food is one, textile is one, paper is one, chemicals is one, rubber. So everywhere where there is industry, there is a significant amount of this the capital income which could be lost. So this is basically the extent of the problem. Now, the other way of looking into the thing is basically doing a bottoms down approach, because India is a conglomeration of 29 states. So, and as you know, the center has divided the states into green zone, orange zone, red zone. So what we did was that we identified all states in terms of green, orange, and red, and then we calculated how much of that is in the urban sector, rural sector, and red sector. We found out that the total GSDP loss for this could actually be around 24 lakh crores, which is higher than the bottom top-down approach, which means it is 12% of our GDP. So that means that the entire nominal income, nominal GDP growth rate of the current year will be wiped out, because we are actually estimating a nominal income growth of around, nominal GDP growth of around 23 lakh crores. So basically our nominal GDP growth could in fact be negative. So this is the extent of the problem if we go to a bottoms down approach. And this you can see that is total, how much is the loss across all states. This also includes West Bengal, and loss as a percentage of GDP, you just see at it. Maharashtra starts at 12.3, Tamil Nadu 12, even West Bengal suffering a loss of around 12% of their gross domestic product. So the extent of the problem is significant if we do a bottom down approach, because that I think could be a better way, because India ultimately is a conglomeration of different states, and the way the center is trying to do is restrict the activities in red zone, orange zone, and green zone, which will impact the states. Which will impact the states, and as you can see that some of the largest states, even some of the eastern states like West Bengal, will be very much hit because of this measure. Now, this is basically the important point, that vehicle sales. This is some of the point which we can actually see. The automobile domestic sales declined to a 123-month low in March. In April, there were no sales. If you look at the vehicle registration related activities, 1 month pre-lockdown was 3.2. Basically, the point again which I'm trying to make over here is that before COVID, we are already doing very badly. So actually the COVID could reinforce our slowdown, which is currently India was experiencing. As you can see, 1 month pre-slowdown, the revenue collection of vehicle registration was already down to 3.28% increase. After lockdown, 1 month, 89%, 2 months, 90%, and 3 months is actually at 89%. So basically, absolutely, there has been no buying of cars if you go by these data. Now, this is an important site. If you go to the Google Mobility Report and compare 22nd March and 2nd May, you can see that out of all categories, people are now actually going more to grocery and pharmacy stores. And because of the fact that people have to also go to offices in residential areas, there has been some movement in the cars. So basically what was happening on 22nd March has actually increased a little bit in the residential area, because people also have been taking out cars to go to offices. But this also says that there could be lockdown may not have been strictly enforced in some parts of the country. So this is actually an indication that maybe we may have lacked a little bit on this lockdown implementation. Now, in terms of what we need to do now, let me come to this, what we need to do. This is basically a comparison of what happened in 2009 and 2010, the fiscal stimulus. The fiscal stimulus in 2020 is actually 2 times than the global financial crisis. And the important point is that if you look into this 2020, what other countries have done, most countries have given support in terms of job retention schemes, and no country is actually giving a support in terms of the traditional fiscal stimulus, which basically is public investment, personal income tax, indirect other tax. Basically every country is focused on how to save jobs, and also a large part of it is also loan guarantees. I'll come to these points later, but the job retention schemes account for a quarter of all fiscal spending. Now, the otherwise is that the other point which I like to make is that there is a lot of noise which is going that India cannot make a stimulus because India has not a budget. Let me now focus some of the points over here. It has been said that India's fiscal stimulus, India has to cut its cloth according to its rating. This is a table which shows India's rating, India's tax to GDP ratio, India's per capita income. Look into the countries which India is clubbed in terms of the rating, look into their fiscal stimulus, and look into their tax GDP ratio. So the argument that India, if for example a country like Kazakhstan and Russia, which is basically triple B minus, the same as India, and having a per capita income which is say 5 times higher than India and a similar tax to GDP ratio, their fiscal stimulus to GDP is much higher than India. Perhaps we need to do much more than what we are doing in terms of fiscal. Even Bangladesh has provided higher stimulus, even though tax GDP ratio of Bangladesh is lower than India. So the argument of cutting cloth according to tax GDP ratio or in terms of the rating actually doesn't stand much ice if you go through this data. So we need to do much more in terms of the fiscal. The other point is that everybody is talking about a false negative of a rating downgrade. Let me tell you that rating downgrade is basically only happens when the GDP growth declines, as happened during the Asian crisis, not because of the fiscal. Look into this experience of all the Asian crisis. The GDP growth actually collapsed minus double digits for some of the countries like Indonesia, and that's why these countries were downgraded. It is not because their fiscal deficit was a huge surplus, it was only at 2% of GDP. So this is basically the important thing which we unfortunately are not appreciating or not understanding the gravity of the situation. And this is another thing which I wanted to show. The sustainability is debt is only possible. What is sustainability of debt? Sustainability of debt is defined by basically the interest rate, the nominal interest rate, where you can take repo as the proxy, minus the nominal GDP growth rate. If it is negative, that means that you have a nominal GDP growth rate which is higher than nominal interest rate, your debt is sustainable. But look into India right now, given the fact that our nominal GDP could actually contract this year, this will turn positive. So that's why I am again repeating that if you do give a support to growth, if your nominal GDP collapses, that could be a recipe for further disaster for any rating downgrade, and not because of the fiscal package which you are going to announce. So these things have to be remembered by the policy authorities. Otherwise, I think the trouble could be much more. Now, let me come in terms of the fiscal arithmetic. I think in fiscal arithmetic, the point is that the problem is the state finances, unfortunately, are in completely dire straits. Everybody talks about the center. This is the states. The composition of the states on text revenue, you can say 45% is states, where the states can't do anything because everything is closed. 27% comes from the center. And as you can see on the left-hand side, the state sales and VAT, which is 20%, state excise is 12%, everything the states can't do anything. So my sense is that this is actually holding back the states, and I think a bigger problem lies with the states. Of course, with the center, but the bigger problems lie with the states. I am a little bit apprehensive that how the states are going to spend money in the coming months, apart from raising taxes on fuel, which of course, unfortunately, in these times, raising taxes on fuels actually will lead to much more negative sentiments. And this is basically the state finances, and looking absolutely fragile. You can see that the consumption of petroleum products have declined by 60% in April. And the states actually have done a lot more in terms of these health expenditure. They have spent 1% of their budget on health expenditure. So with the crisis, there is a triple whammy of reduced tax collection, higher health expenditure, and lower tax GDP. This will push the state's fiscal deficit to at least 4% in the current fiscal. Now, this is basically the state fiscal deficit. So the state fiscal deficit of the center could actually increase from 3.5% of GDP to around 7% of GDP right now. The states could act, and if you add the extra budgeted resources, it could go up to 8.2% of GDP. The state's fiscal deficit at 4%. So that means the consolidated deficit could be as much as 12% in the current fiscal. And this is the market borrowing. You can see that the total borrowing could be actually around 20 lakh crores of borrowing in the current year. I mean, of which center will borrow 10.5, the states will borrow, 6.9, 6.4. So this is basically the extent of borrowings in the current fiscal, which is an humongous number. And the other thing is that why, and we estimated basically how much of this borrowing could be made from the market, because that will have a pressure on the interest rates. If we just do a demand supply calculation of the government security paper and do assuming that the banks, provident funds, insurance companies continue to buy at the same rate at what they were buying, I mean the percentage is the same, I think even after that, the total gap to be filled by the RBI has to be around more than 4 lakh crores, which is basically a underestimate, because we are assuming that everybody's appetite will be same. The RBI needs to monetize or do an OMO. In my sense, they have to ultimately monetize, otherwise things will go out of control. So this amount could be as much as at least 4 lakh crores. Now, let me come to some good news, at least on the external sector. The external sector will have a current account surplus, which I think will be happen after 1977-78. So basically, after 43 years, we'll have a current account surplus. We'll have a balance account payment surplus of 2.5% of GDP. So therefore, the rupee actually will see an appreciative bias this year. So this is perhaps the only good sign apart from all this bad news. And there is also a crisis to opportunity to trade. We did an estimate saying that where are the items where India has a comparative advantage. You can actually see that India's comparative advantage lies in consumer goods, and in consumer goods, ultimately, unfortunately, the SME sector is dominant. So therefore, you have to push the MSME sector in doing something, and we have a comparative advantage, so we can actually take an opportunity of this crisis. We can make an opportunity out of it if we do play our cards correctly, at least in terms of the external sector is concerned. This is an example which I have given. I think even if India were to take, this is some of the items where India has a comparative advantage, which China is also exporting in 2019. You can see that the first two columns shows China's exports, the second column shows India's exports. Even if I assuming that 1% of that Chinese share India captures, it could go up by 100 billion. So that is a number. That's not a small number, and that is basically 100 billion is close to around 8 lakh crores, which incidentally could be the increase in the fiscal deficit for the current year. So I think if we play our cards correctly, there's a lot of advantage which we can also take it out of this crisis. So that is basically the point which I want to make over here. Now, what will be the impact on banking and insurance? The banking and insurance, the important point is that in FY20, we ended the year with a very low credit offtake. But there are some good signs is that in the March 2020, the incremental credit growth in March actually were at record highs. That you can see the amount was actually at 3.57 lakh crores, which is the largest since 2009. So therefore, what has happened is that a lot of corporates have taken credit from the banking sector in the last 10 days of March, because they wanted to ride through the storm. And the important point is that whenever these companies take
Anirban, what is the problem?
It seems his connection has gone dry. Let me check.
Ah.
I'm sorry, he has just got disconnected. Just give me 5 minutes, all of you. I'll just get in touch with him once again. He probably his bandwidth is too low to keep this going. Just give me 5 minutes, please.
অনির্বাণ
Sir,
উনি জয়েন করছেন, আমি ফোনে কথা বলেছি। He is aware that he is gone offline. He is rejoining.
Okay. Mr. Roy also went offline. Okay, I'm here.
Mr. Barua Anirban, I can hear you.
Yes, sir.
The problem is with Dr. Ghosh's side. So I have just spoken to him. He is trying to get connected again.
Okay, we'll wait.
We can see his presentation. We can't see him.
No, his connection is too low. He's rejoining once again. See, he has got disconnected now. He'll join in a few minutes. I could see that he was facing this connection problem all throughout. His bandwidth was showing red to yellow. That was just a few minutes.
আমাকে একটা কাপে ড্রিঙ্ক
Just a minute, Mr. Ghosh is joining. Just
Hello.
Dr. Ghosh, yes, we can see you.
Yeah, we can start now again.
Yes, you can please take over.
Yeah, my slides are visible.
No, it's yet not visible, sir.
Just 1 second. I'll just share it again. Okay. It's not visible. No?
Just go to the share screen again and start off.
Yeah. Just 1 second.
No problems.
I think there was some problem. I'll just 1 second. Yeah. Yeah.
Yes,
Yeah.
it's visible.
So it's visible now. So I can start.
Right. Yes, sir. Please.
So sorry for the disturbances. Just like any other pandemic crisis, there was also a crisis, but we have managed to get rid of the crisis very quickly. So basically, the point which I wanted to mention over here is that if you look at the sectoral deployment of credit, what has happened is that there has been a significant credit uptake in the month of March, and the banks actually have expended significant amount of credit to the NBFC sector, which was around 1.15 lakh crores, and industry was 1.34 lakh crores. This amount is the maximum from 2008. So therefore, banks are expanding credit, and it is not correct to say that there has been a credit logjam from the system. But as I showed you in the earlier slide, the credit is also not coming back in April. So that's a good sign. That means the companies are actually conserving cash so as to tide over this crisis. Now, this is basically the life insurance business wanted to show. I think in April has been a complete washout. Everywhere you can see that there was actually no group single premium paid. The policies, the premium has been declined by 33%, and that non-single premium, actually there has been some amount of growth in the non-single premium, so it's like a 33% growth. So the point is that the insurance sector has not seen a complete washout as the bank, as like the other sectors. So this is actually a good sign that people are actually have bought some insurance policies in the month of April, even amidst the lockdown. So that actually shows that there could be some churn in the financial sector, and possibly the insurance sector could be one of the beneficiaries of this pandemic crisis as people became more risk averse. So this is one trend which I wanted to tell you. Now, let me tell you about the sectoral impact. I think the sectoral impact, the important point is that these are some of the sectors. These are the issues and these are the impact of COVID. Wherever the sign is red, that means that the impact of the COVID is significant. The first is automobile, because there will be, I mean, a lot of these are imported from China, and also the demand for cars, hotel, restaurant, leisure, of course, aviation, as you know, of course, there will be a significant impact. Gems and jewelry will be another sector because of the income loss. NBFC already is doing badly. Real estate, I think, will see another bout of this crisis as happened in 2009-10. Construction and engineering. FMCG, there could be a medium impact because lower demand from China will lead to surplus of fisheries in the Indian market. So there will be some impact on the allied activities of agriculture. So that's actually a reason why we are saying that the agricultural sector could also take an hit. The steel sector, the metal sector, the cement sector, the textile sector, and the pharmaceutical sector, all of this impact actually will be muted. Now, this is another important slide which I wanted to show you, is that we are actually doing very badly even before the COVID crisis. This slide shows the credit ratio. The credit ratio is nothing but the ratio of upgrades to downgrades. So basically, if you look into some of the sectors like automobiles, hotels, aviation, gems, NBFC, steel, textile, all these sectors actually had a negative and that significant decline in the credit ratio in the second half, April to September. So this means that these sectors, October to March, second half of last fiscal. So that means the sector were doing badly even before the COVID started. And if we just juxtapose the impact of COVID, automobiles, hotels, aviation, gems, NBFC, real estate, construction, the impact is actually significantly in the red. And these are all going to impact the banking sector significantly. I mean, there will be a change in the business model, but obviously, I think the banks will have to be very particular in terms of their portfolio because, I mean, and they would like to avoid a situation similar to 2010-11, where there was a lot of increase in the NPA because of significant lending to infrastructure sectors. Now, these are the sector outlook. You can see that the red means above 30% impact in revenue profitability. This yellow means 16 to 30%, and within 15% is only some of the sectors like ITES, FMCG, and pharmaceuticals. So we can actually see that there's a lot of red over here in terms of revenue. So I think the sectoral revenue and the profitability outlook doesn't look promising as of now. Now, what is the government needs to do in terms of the fiscal and monetary support? I think I'll go through these slides quickly because this is already known, but RBI has actually done a lot in terms of the support. RBI has cut the rates by 75. It will, our projection is that it can cut the rates by another 100 basis points during the year. It has increased the MSF limit. It has actually also reduced the CRR, and it has done a whole lot of, and it has also taken a targeted package of TLTRO so as to help the NBFC sector. These are some of the mentions. CRR has been cut, LTRO has been introduced, marginal statutory, and all these measures actually has has released liquidity around 3.754 lakh crores into the banking system. Now, this is basically, now we are coming to the fiscal support. Unfortunately, in the fiscal support, you will see that this is the package the government had already announced earlier was 1.7 lakh crores. But if we just do a very district analysis of this, only 73,000 crore new, and the rest were actually from other, within the government budget. So 73,000 crores is only 0.4%. We need to do much more that in terms of there are some of the things the government has done. Some of the things the government has actually done, that in terms of the PMGKP program progress so far, you can see that it has given and released an amount of around 35,000 crore. But I think some of this comes from already within the budget, like the Prime Minister Kishan. So we need to do outside the budget, which we have not done till date to a significant extent. Now, states are actually, interesting part is that this is the states I have supported. States actually have released 1.7 lakh crores. States have 1.7 lakh crores, which is almost similar to what the center has done. So it is, I think, so basically we need to support the states in their endeavor. And as I have shown you in the earlier slides, the state's fiscal position may not warrant that until and unless we come out with such policies to support them. So what are the supports which is needed? These are some of the other countries doing. Singapore, every country has done a lot. Singapore, Malaysia, UK, Italy, everywhere you have done a lot for the MSME sector. The mortgage payments have been deferred. 0% interest loans to SMEs has been given. Government guaranteed loans to SME has been given. Moratorium on mortgage payments have been given. In India, we have given a 3-month moratorium on the term loan. Possibly this will be extended, but all other countries have done much more. And as I have showed you, that countries with similar ratings, similar per capita income are perhaps doing much more than what India is doing. And what we need to do is that we need to do and support to the banks to India. Adequate liquidity the RBI is doing. The government needs to provide some risk capital to the public sector banks, but that amount actually we had calculated could be very insignificant. The first thing is that they need to capitalize the public sector banks to a little bit, but the important point what is that they have to create a guarantee fund, and this guarantee fund should have 100% guarantee. For example, suppose if the amount of credit guarantee fund is 3 lakh crores, and if the total loss is around 10%, that means the government has to give a support of 10%, 30,000 crore to these sectors. And this credit guarantee doesn't need to come to the banks. They can create a different credit guarantee fund, and this fund can be given to this particular sector, whereby, and that has to be spread over a period of 3 to 4 years, because as you know that the bank's asset quality cycle, the provisioning cycle is around for a period of 3 to 4 years. So I don't know what is stopping the government from doing this. I understand that they may not give full guarantee, but if the guarantee support is around 20% or 30%, which the thinking is going like, this is not going to help the SME sector or the banks to any extent. Now, in terms of crisis to opportunity, how we can make it an opportunity? There are some steps which I want to say. First is that we need to reorganize the supply chain. There are Japanese budgeting 2 billion from Japanese firms in China. We have actually also done some amount of labor reforms, but unfortunately these labor reforms what we are doing, for example, in some of the states, are actually not that labor reforms what I will talk about, because these are abdicating some of the safety responsibilities which may be best left out. The other thing is that the more countries are putting Chinese capital under approval route. There are geopolitical tensions. There has been rising of US-China trade tensions. So there is another example where India can take advantage. I think this talk will go up till US elections, but there is a real possibility that there could be some amount of US-China trade tensions where India actually can take advantage of that. So what could be the policy strategy for India post-COVID? The first thing, as I said, is that we need to support having a fiscal support. As I said to you that the total budgeted borrowing is around 20 lakh crores. The RBI needs to support the sector with at least 4 lakh crores of money. that amount of money could actually be done through innovative mechanisms. For example, one of the innovative mechanism we are suggesting is issue of perpetual bonds to RBI. As you know that perpetual bonds have been, this time also they have been issued by state countries like Spain, whereby and in perpetual bonds, since you don't have an principal payment, so that means that the debt servicing doesn't become an issue. The other thing, and we can also think of an long zero coupon bonds of a longer tenure. Germany has tried this. We can also try this, but I think these are all things which are in the realm of the government, and the RBI needs to seriously monetize the deficit. I think monetization has been a toolkit of several economies throughout the world, and given the fact that the money multiplier currently has significantly declined and there is no demand, there is no possibility of any inflation, which we need to understand. The second is that MSME sector has to be supported through a credit guarantee fund, full 100% credit guarantee, a part of which also could be used to give salaries to the MSME sector. Some sort of a payroll support is absolutely needed, because I empathize with the industry, because if you don't have revenue and you have to pay your staff, I think that's always a difficult job. The third important thing is that we need to push the health sector through tax holidays for drugs. This 15,000 crore emergency health package we estimated could create a demand for 80,000 crore over the next 4 years. And I will just give an example that India has around 700 odd districts, out of which 500 districts doesn't have any hospital. So even if we were to create an 500 bed hospital in this 250 district over the next 3 years, that will take around 20,000 crore per year. So I think 20,000 crore again is not a big amount, and we must do this, because otherwise what is going to happen is that I think we should miss this opportunity in terms of building up the health infrastructure. The other thing is I don't think that will be done, because the domestic retail oil prices should have been reduced from the current levels, but I don't think the government is going to do that because they don't have any source of revenue. But I think that could have been a very good policy. And the final thing is that the staggered package has to be given first to the green zones, followed by orange and red. What are the other things what the government can do to make it an opportunity is that increase the share of GDP from 17 to 25% in 5 years, give an unified fast track clearances. For example, state nodal officers to coordinate with the central department, and that will be one-stop clearance mechanism to aid land acquisition, environment and water availability. Low stamp duty registration, technology development fund, comprehensive industry by industry roadmap of revival, and Government of India package for SME and MSME sector for targeted cap subsidies, which could be given for further employment generation. And what will be the exit strategy? This we have suggested the government that they should start construction activities in districts whereby there has been no spread of the disease. The agricultural sector should be allowed to perform. Trading activity should be retail trade. Hotel services, including home delivery, should be started, and which is actually started. That's a good thing, because this employs a significant amount of people. Then digital infrastructure needs to be pushed, and the government should start economic activity. But the only thing is that all this will be symbolic in nature, because more than 90% of the bank credit is actually in the red affected districts. The other way is a demographic strategy, is that instead of getting into the states into red, green and zone, you can divide the population into 4 groups like hospitalized, immunity, healthy and others, and then have a well-defined strategy for each group. But at the end of the day, let me end by saying that these are all suggestions. The government has to take a call to how to make a staggered exit. But I think for a country of the size of India, lockdown cannot be a one-size-fits-all approach. And we have done remarkably well in terms of containment of the disease, though the peak is yet to be achieved, but we have not done at all in terms of having a package to support our industry, lives and livelihood. So please remember that we may have saved lives right now, but there is also a trade-off that people actually, some of the people, as the experience of global financial crisis shows, at that point of time, there was a lot of suicides and deaths because a lot of people died of starvation. So I think raising lives is also raising people from, saving people from starvation is also one important objective we should try to achieve. I would like to end here, and if you have any questions, just let me know. Thank you.
There are several questions that have been coming up, and let me just sum up some of them. The question from Mr. Shudipto Roy of Exide, he's saying most companies were on a capital expenditure spree, but they have stopped it. This will have a spiraling effect on the entire economy, particularly the capital goods sector. How serious is this problem? When do you foresee this easing?
No, I believe this is a very serious issue, and I don't foresee this easing anytime soon, because I think the important point is that if you don't have any revenue, you cannot have a capital expenditure, neither you can pay your staff. And until and unless the government comes out with a package to support some of the industries, I think this will be a very difficult journey road ahead. As you can see that the states are in a very bad shape. And my sense is that even the capital expenditure by the center and states are going to be significantly cut. Otherwise, I think within 20 lakh crores of budget and within 5 to 5.5 lakh crores of additional borrowing, which is now coming in, I think it will be humongous task. So I don't see it at any point of time it easing soon. It may actually deteriorate a little bit from the current levels.
Thank you. The second question is from Arup Banerjee. Is it possible a way out? Is there a possible way out to allocate a portion of the money from the Prime Minister's fund for small-scale industries so that they can cover up financial damages, including fiscal and monetary strategy?
Yes, I think that could be done, but I think that amount of money, I don't know how much has been collected. Even if I assume it is around 9 to 10,000 crore collected, I don't think that amount of money is very high, so that could be distributed. But as I said, that the best way to support the SME sector, there, why don't you create just a guarantee fund? All countries are doing it. As I showed you at the beginning of the slide, the composition is all countries are supporting through a job retention scheme. They are giving a payroll support, SME support. Why can't we do that? I think the chances of a rating downgrade are significant if we don't do anything on the fiscal, because even if we don't do anything on the fiscal, our fiscal deficit will automatically cross 10% because there will be a significant revenue slippage. So from that point of view, if we don't get get us back on track, I think we may be in for real difficulty in the future. So I don't see any reason that why it couldn't be done. And all this talks about fiscal, we don't have money and all those things. Yes, we are a fiscal constant economy, but look into example what other countries are doing. Let me give you the example of Italy. Italy's rating were downgraded by S&P, but even after that, Italy declared that it will do whatever it could do to support its ailing economy. So I think, yes, there is always a chance of rating downgrade, but I don't think we should give importance to these ratings, because from 1992 till 2020, India has only one, I repeat, one net rating upgrade for 28 years. So is one net rating upgrade important to us, or to saving the livelihood and the lives of the nation is important to us?
Correct. Rightly put, sir. Next question is from Jayanta PC. He's saying, do you foresee that more banks in India might be in trouble?
See, from a banking sector, the point which I'm trying to mention is that, let me answer it in a different manner. The point is that, which I want to mention is that the risk has to be taken up by everyone. I mean, if tomorrow, for example, the government comes up with a package by saying that we'll only provide 20% or 30% of SME guarantee, I think there is every reason for the banks actually not to go ahead to shun that package, because the risk has to be shared by the government. As I told you, it's an amount of 40 to 50,000 crore over a period of 4 years, which is nothing. So until and unless everybody in the financial system, including the RBI, we have been suggesting to the RBI that it needs to buy corporate bonds. It has to take corporate risk in the portfolio, so that, the risk is shared. If this is not done, we may ultimately have to land up in a situation whereby the government and the RBI had to create an SPV whereby all loans will have to be taken, the entire credit risk will shift to the RBI. Because if the risk is not shared within the system through government, RBI, and the banks, I think we'll not find a solution out of this crisis.
The next question comes from Dr. Jain Mukherjee, who is a committee member of CMA. He wants to know why the government of India is not giving a much higher stimulus. It is only 0.8% of GDP. Can we take it to 2% of GDP?
2% of GDP is the minimum amount, and as I said to you, the total, if I take a top-down approach, the total GDP loss, as I said, is around 16.5 lakh crores. So there are talks that the government will limit the deficit to around the package to around 2 to 2.5% of GDP. So that makes it around 4.5 lakh crores, because every 2 lakh crores is equal to 1% of GDP. So that means 12 lakh crores could be the permanent output loss to the economy, which is equivalent to 6% of GDP. And so you can understand the humongous nature of that situation. So I think any package, even at 2 to 3%, will be negligible. As I showed to you in one of the slides, even though that 1.7 lakh crores as government has given of 0.8%, of which only 0.4% is new, and the rest is actually, from within the system. We have to do something to do outside the system. And the important point is that, if we have so much amount of, given the fact that the problem is so humongous, my only suggestion is that we also need to take out a plan for the next 2 to 3 years, how we are going to finance this deficit. But 2.2% or 2.5% of GDP, in my sense, will be inadequate.
Thank you. The next question is from Dr. Lalima Mukherjee. She's asked, what is your take on unskilled laborers and daily wage workers? Do you think that poverty is the more important killer than COVID-19? Could you please throw some light on it?
No, as I said in the beginning, that the total income loss is around 7 lakh crores, of which 25% is because of the migrant laborers. So you can understand the extent of damage the migrant laborers have taken. Is unfortunate that, the migrant laborers have been going through a lot of pain, and so there will be a significant income loss. And that's why I said at the beginning that saving lives is also important during the crisis and after the crisis. So therefore, we have to take a very measured view of the lockdown. And the other thing is that since most of these laborers have now gone back home, they will not come back. And I am a little apprehensive whether economic activity, at least in the construction sector, could start before Diwali. So that is because during the rainy season, there are no construction. So by June, the rains will start in the parts of Mumbai, other things. So if the monsoon, the forecast is monsoon is good. So if I leave aside those monsoons, I think we can actually hint for a long rainy season, and that actually could delay the recovery even further.
Thank you. The next question is from Mr. Anil Garg, who's the treasurer of CMA. He is saying, if the economy is bad, then why are the stock markets going up?
I'll tell you one thing. Actually, the issue is that the stock market also went up before 2008. So that is also one thing which you need to, actually the stock market going up is a sign that the economy is not doing that well. We have to look into an asymmetric manner. And let me give you some examples. The extent of activity in a stock market, whether it is good and bad, is given by the speculative activity. We did an estimation recently in terms of the most of the sectors, around 20 sectors, to understand what is the extent of speculation. And you will be surprised to know that in most sectors, the extent of speculation has significantly increased. That we found out an index has increased from March to April than what it was in January to February. So therefore, I think we should discount the movements in the stock market. Even the stock market actually has declined and what you are saying, the stock market is going up, but I have seen the stock market has declined. And as the results will come out, and as you progressively will get into the next couple of months, I think the stock market will reflect the economic fundamentals. And I'll not be surprised if the market goes down from the current levels, because right now what is happening in the market is mostly speculation rather than anything else.
Thank you. The next question is from Mr. Sachin Joshi. He is asking that on one side, the government is asking us to manufacture sanitizers and sell them at lower controlled prices. But on the other hand, the state government is increasing state excise duty on alcohol, which is the core raw material for sanitizers. Should not the government give exemption from state excise duty and other benefits for alcohol procurement?
No, I would have been happy if there was, the states would have been able to give that. But unfortunately, as I showed you in one of the slides, I think the states have no source of revenue as of now. And even though in my sense, GST was a landmark reform which the government did, I think GST is ultimately a consumption tax. And introducing a consumption tax in times when there is a slowdown mode, I think that may not have been the appropriate time. But anyway, keeping aside that, I think we also have to need to understand that the states have no other option. I would have been very happy if the oil prices have been cut, but I don't see any respite from us from the higher oil prices, because GST collection, as you know, for April data has been released. My sense is that it has been almost less than 10,000 crore. So if that is the case, then and a large part of that money comes from the central revenue, around 30 to 35%. So the states are not having any money. The state's WMA has been hiked, but it needs to be hiked much more than what it has been done. The states needs to be supported through a interest-free WMA limit, and the center needs to monetize, and the monetization and a part of that monetization amount needs to be shared with the states, because at the end of the day, I think the states also are at the forefront of the COVID battle. There are examples where some of the states have done very well. For example, Kerala is an example, and my sense is that ultimately we have to support the states. I know we're in a difficult situation, but as of now, I don't think that, what you were saying may be correct, but I don't see any reason that whereby we can make an exit out of that.
There's a question from Mr. Pankaj Bajaj, who's saying, due to the BOP situation, is something that we should worry about? Are we looking at a stagnation in the future due to breakdown in supply chains?
No, I think exports, I think the external sector is the only sector which will look good, not because that we'll do good in exports. We are assuming a 25% contraction in exports, but because of the fact that oil prices last year was 129 billion. This year, the import bill could be as close as 30 to 40 billion. So that means we'll save 100 billion from there. So 100 billion is actually equal to 7.5 lakh crores. And that's the same amount of money which I said at one of the slides, is that which actually we can gain if we had to integrate into the global supply chain. So my sense is that external sector, to me, by default will look well this time, and that will actually put some positive tweets on the value of the rupee. And if you remember, in the 2011 crisis, the rupee had actually appreciated after the crisis in 2011 till July. The rupee had touched 45 from 55 or 57 at the time of crisis, after which it started depreciating because the US's actually were downgraded in terms of the rating. So I am a little optimistic on the rupee front, and which I think will be a positive for the Indian economy going forward.
Thank you. There are two other questions. In fact, I'm combining a few questions and making it into two. We have two sectors which you mentioned in your talk, which is the service sector and the MSME sectors. Now, the issue is that both these sectors have been badly affected by the lockdown, and many whose scale is not very large are living on who live on a hand-to-mouth existence are finding tremendous revenue deficiencies. Is there any plan from the banking sector or from the government to help them revive, survive, or even expand and grow?
Which sectors you talked about? Which are the two sectors?
MSME and service.
See, the MSME sector, as I said to you, is actually the banks. In terms of the emergency credit lines, I think already there has been a lot of expansion in bank credit in the month of March. but I think there, I mean, some amount of guarantee needs to come from from the center guarantee fund, which basically could be over and above the CGT SME, what the bank, what the center is doing. And I think actually that could start the lending process. This is a very simple thing to do. Just put some money into a guarantee fund and tell it to the banks will start lending. So that is one thing. And in terms of the service sector, I think we are looking into each of the sectors very closely as of now. And apart from the hospitality sectors, I think which looks a little bit promising at this point of time. And as I've said, that demand from the hospital sector could actually add a lot of value. I think regarding other sectors, it will be on a case-to-case basis. So it will depend on the risk perception and also on the also on how their business activity is going to change in the coming days. So it's difficult to say at this point of time, but I don't see a problem from the banking sector until and unless the account is actually good. But it will be a completely on a case-to-case basis rather than on a sector basis. So you can actually find some sectors in some of the stressed, some of the companies, some of the stressed sectors getting credit rather than the opposite way around.
Thank you. You mentioned in your talk about, China losing out revenue from global trade and interactions, etc. And maybe there's an opportunity for India. So given the circumstances, how does India get in foreign investment, foreign production, foreign technology, like it has done ever before? Is this another opportunity for India to open up and welcome foreign investment into our country?
See, I think this is a great opportunity for India, but we have been thinking about this for a long time. And as I said to in one of the slides, that the extent of this support is humongous. And I think the government is seriously considering it. If I speak to some of the trade and commerce ministers, but we have to move very fast on this, because some of the economies like Vietnam and other countries have actually moved much ahead of us. In fact, countries like Bangladesh, Cambodia also have moved much ahead of us. And that's why it is important that we support these sectors like export sectors. We need to some of the rules in the special economic zone sectors. Labor rules change are good, but we have to make it more comprehensive. So I think there is an opportunity lurking there, but we have to take advantage of that one. We have been talking about this now for the last several years, but right now it's a time for action. So yes, there is a big opportunity, but I don't know what are the plans which the government has made. Last time, what I understood and what I have told the government, that they were actually setting up a separate desk, which also we have suggested separate desk within the ministry to get in touch with all those companies you want to shift. And I think that is one way of having one point of contact whereby you can lead these companies into India and integrate India with the global supply chain. So some of these things are in the consideration, but we have to act fast on this.
Thank you so much, Dr. Ghosh. Thank you so much for the time and the effort that you have made to get to us. It was indeed very, very eye-opening and very, very a big learning process for us from what you told us today. May I now invite our president, Mr. Amitava Dotto, to say a few words. Mr. Amitava Dotto, please.
Thank you very much, sir, for being with us today. I think it was a great opportunity for us to really understand what was happening out there, because a lot of us really did not look at it in this perspective. Thank you very much for, really explaining the situation. And I think at least I personally have a much better view of what is happening. I just wonder why a government which was so active in sort of saving lives is dragging its feet to save the livelihood or do something about it. I mean, I honestly don't know. I don't know whether you know, and I'm sure all of us at the meeting today, all of us would actually want something to happen pretty fast on the livelihood front. With that, thank you very much once again, Dr. Saab, for being with us and for sharing your thoughts with us. And on behalf of the Calcutta Management Association, I'm sure We will get in touch with you in the future to have your guidance, support, maybe as and when possible, as and when you're in Kolkata, have a physical meeting with the rest of our members. Thank you once again.
Thank you.
Thank you very much.
Thank you.
Thank you. Thank you
Thank
so
you.
much.
Thank you so much. Thank you.